Hello everyone. Today I'd like to share our current thoughts and also explain a couple of things around what's happening currently in the equity markets. Now, some of you have asked us during our recent reviews as to why the economy and the share market is effectively moving in the opposite direction. COVID-19 cases continue to rise around the world and the number of deaths seem to also increase, but there is no vaccine soon in sight. Yet the share market seems to continue to hit new highs, and they keep reading headlines about share prices doing multiples since the troughs in late March 2020. So one of the things I want to explain today is, why is the share market and the economy not moving in sync with each other? One of the fundamental reasons of this is, if you consider in normal times when there isn't a crisis, share prices usually reflect the earnings or the profits of its companies. Right now, that is simply not the case. One of the reasons why is to do with interest rates. Interest rates at the moment are very, very low. And at the same time, inflation is also incredibly low. When you combine those two things together, investors have very little choice as to where they can invest to derive a return. If you consider a term deposit rate today, this week, it's around 0.6 to 0.7%. That is all you're going to get. And that's interest paid to maturity. When you then consider, when you look at certain headlines and you see some names, say in the buy now, pay later space, where the market's gone, multiples of times, in some cases the share price has gone 8 to 10 times since March, you start to wonder why we're not participating in those sort of investments. If you consider the entire world's equity markets that's coming up on your screen now, you will see that there is a big divergence between performance amongst different sectors, with the worst performing sector in global shares being energy, which is mainly revolving around the fact that oil prices went from around $60 a barrel down to $20, and now they're back to around $40. So the blue lines represent how far the markets went from the top of the market, which was around February 14th, down to the bottom, which was March 23rd. If you then consider some other sectors, global real estate as well as financials are the next two worst performing, obviously because a lot of retail shopping centers or other listed REITs also are subjected to decreased levels of rent because their businesses that are renting off them simply can't afford to pay the rent. But the most high performing companies have been IT. Where IT from the peak till now, and so I'm talking about from February, has regained all of everything that it lost, and it's added around 10% to its total return profile. So that is something very, very interesting to see. But not only do we see that different sectors within the global share markets have had very markedly different returns over the last couple of months, but even different regions have also seen very different return profiles. As you can see on your screen here, you see that the different markets from the UK, Australia, all the way to the US on the right-hand side, you can see from peak to trough, the Australian market is one of the weakest markets during this crisis. All markets are still currently below their previous peak. This is up until the 13th of August. But at the same time, what you can see is that Asia has been one of the strongest performing, even though it has dropped around 30% from the highest point till the trough in March, on the March 23rd. Since then, it's recovered almost all of its losses. Whereas if you compare against somewhere like Australia, Australia is still around 15% below its highest point. So depending upon how your asset allocation has been derived and where you currently sit, it will then determine the performance of your portfolio. At the same time, if you've had more assets invested in illiquid assets, let's say things like direct property or mortgages, then obviously the underlying volatility of your portfolio has also been lower. That is not necessarily a good or a bad thing, but for some people, when their retirement savings, they want to see a more stable line of return or income, they don't necessarily want the level of volatility that listed shares has, and that they have to endure through that period. So that's all for today, and if you have any further questions, please reach out to your advisor at the SWU Group.